Welcome to TheoTrade. This is Don Kaufman. It's December 14th, 2018, and you are watching the TheoTrade Weekend Update. All right, here we go. Pretty much into the last, what I would term, real trading week of the year. That's obviously kicking off this Monday. To throw in there a little bit of confusion, we've got an FOMC announcement. That FOMC announcement, of course, will be this coming Wednesday. Then we've actually got the news conference from none other than Jerome Powell. But put the Fed aside. Listen, you guys are going to have to listen to Fed speak all throughout the course of this entire week. You're going to be bombarded by Fed speak. Bottom line is, right now, there's about a 78% probability that the Fed is going to bump by about a quarter point. Enough said. That's it. In fact, when it comes down to it, I actually think that the move in the markets is going to happen prior to, that would be on Monday, Tuesday, or even early Wednesday, prior to the FOMC announcement. With that kind of being said, let's look where the markets are right now and what we can really expect. In fact, I'm going to spend quite a bit of time in the charts and some option chains, kind of taking you through a couple of what I would call absolutely imperative trades to understand for this coming week. All right, so the markets throughout the course of this last week, the only way I can really describe it is the futures markets. They were just trading sketchy. S&Ps were all over the place. Throughout most of this past week, the S&Ps tracked, moderately higher and gave it and then some back, of course, on Friday. The S&P is closing down just shy of 50 points on Friday, give it all back for the week. But net, the week was not like a huge loss. Now, one of the points that I want to make with that is, last weekend we were talking about the volatility box. What's the volatility box? The volatility box was a level from 2,600. That was kind of the floor, 2,600 in the S&Ps, on up to about 2,800. Isn't it ironic that the S&Ps basically closed on 2,600? Now, that isn't helpful at all because, quite frankly, we haven't broken the bottom of the volatility box. However, there is two areas that we really have to kind of focus on, and that's going to be the financials. Specifically, I'll show you a trade here in XLF in a couple of moments, and the Russell or the IWM, which is the Russell 2000. Both the financials and the Russell have actually broken considerably lower, okay? And they've actually broken outside of their own kind of, volatility box. But it leaves us in this incredibly kind of precarious area in the markets. Okay, there's no question right now we are at a crossroads. And, I know a lot of people are going to come out and they're going to be like, okay, we're going to have the Santa Claus rally is coming. Listen, I don't even think Santa is going to save this marketplace. But when I say that we're at a crossroads, okay, and you're going to have to listen to all this rhetoric and this noise, if you will, about the Fed, and that's all it comes down to. All right, what's the precarious situation that we're in? Right now, the marketplace is undoubtedly poised, okay, to just rip apart and take off to the downside. No question about it. I still are maintaining bearish positions at the exact same time that I'm saying that. And again, I'm going to show you this in just a couple of moments because it's going to sound a little bit perplexing. So net, markets are going to break lower. That is what we would expect. Okay. But this very next week, here's the crossroads. This next week, because you have the financials considerably lower, because you have the Russell beaten down, it leaves us in a position, okay, that both the financials and the Russell can spark what we would term a rip your face off rally. So even though, okay, that we believe that the marketplace is going to eventually drive considerably lower, we have got to hedge the upside risks and specifically hedge those risks inside of the financials and inside of the Russell. And I'm going to show you that here momentarily. Last couple of thoughts, okay, on this front. The S&Ps, they had about an $82 expected move this past week. We stayed well within the $82 expected move. But as I said a moment ago, okay, the markets just felt downright sketchy all throughout the course of this previous week of trade, right? This coming week, we're looking at about a $65 expected move. Now, $65 doesn't sound like that much when you're just coming off like an $80 plus expected move in the previous week. But you have to kind of think about, like, a lot of people are going to be bailing out, okay, come Thursday or Friday. We're coming into the holidays now. As I said, this is the last kind of week of trade. And again, I'm not even sure Santa Claus can save this market. With that, let's go ahead, look at some option chains, look at a few charts. Let's get to it. All right, into the charts we go. Let's kick it off with a look at the SPX. Now, as I was mentioning a moment ago, the single most important thing to me in this next week happens to be what I feel like the markets are kind of at a crossroads. And when I say a bit of a crossroads, so let's kind of zoom in to what I term once again the volatility box. I was talking about this, of course, on last weekend's video. Here is our lovely volatility box. And as I kind of denoted, the volatility box is 2,600 pretty much up to 2,800. And we've just been kind of house of pain inside of this, or what I was dubbing the hurt locker. We're literally on the lower edge of that volatility box, and we're ready to explode down through it, which when we do eventually break to the outside of that volatility box, there is no question it's going to turn into a little bit of Pandora's box in terms of volatility. That is where I believe that the VIX will absolutely spike to the upside. But the point I want to make with this, we're at a little bit of a crossroads right now. And as again, I've said that a couple times. Let me get into some detail. Here happens to be none other than the Russell. I'll start with the Russell. Here's the Russell and its kind of volatility box. Again, this exact same volatility box can be found in the Russell, the Spiders, the Nasdaq, the financials, even individual stocks, which I'll show you here a little bit later. So we're boxed in on the Russell, but we took off to the downside on the Russell. Okay, so if you've got positions on the Russell, I mean, those things are working for you. The exact same thing kind of exists over here in the financials. So the financials have seen this kind of, again, really wicked volatility box, 25 being the lower edge of it. And the financials cracked and cracked hard and actually closed, okay? I mean, hideously lower on today's session. Again, this was Friday, of course, December 14th, and closed hideously lower on that. So what's so precarious kind of about this? And this is where I said, no matter what you hear, all the rhetoric and all the garbage that's going to be out there about the FOMC this week, listen, we know that there's about a 78% chance the FOMC is going to bump those rates by a quarter point. Enough said. What's the marketplace going to do? The crossroads I keep talking about, it's right here, okay? This is the product, along with the Russell, that is going to break us apart or take us massively higher. Now, if the marketplace was to have that quintessential rip your face off rally, of course, people then, they're going to dub that the Santa Claus rally, right? But if we're going to have that huge bounce, that rip your face off rally, this is the product you're going to want to protect yourself in. Now, I have positions. I have positions in the XLF. I also have positions JP Morgan, but I have a ton of different positions. But here's the bottom line. If the financials rally, the entire S&P is going to rally, and it's going to hurt a lot of my net positions out there. And that's the key. And I want to make this really, really clear. I, Don, okay, am bearish, okay, which implies that I have negative delta on. And I absolutely do have negative delta on, but I'm nervous. And the crossroads that we hit, if we break lower and break hard, beautiful. I'm set up for it. If we explode higher, negative delta is going to get absolutely hammered. How do I mitigate my risks? Okay. Well, what I'm going to do in this particular case, you can see I've already got a position on. So yes, I've been allocating to this already. We're going to sell a 24.50 and we're going to buy 1, 2, 3 of the 25s. All I'm doing here is a call ratio back spread. It's a pretty tight call ratio back spread for a whopping 7-cent debit. So let me right click on it, drop it over to the analytics tab and kind of zoom in and take you through a little bit of a gander, of course, of this particular trade. So let me hide the price slices and make this really, really clear. Okay, 7-cent debit. So here's the good, the bad, and the ugly. First and foremost, where are we trading right now? Here, okay? What is here? 24 and change. Okay, if we break lower and break hard this coming week, and again, let's talk about this coming week. We break lower and break hard. That's anything below, 24.24. Okay, the most you can possibly lose on this trade if we break lower is 7 cents. That's your debit. It's 7 cents debit. Okay, if we explode back to the upside, that quintessential rip your face off rally, you got nothing but blue skies, but you kind of got out. You have to really get out of what we term the valley of death. Now, this kind of harder line right there, that is at expiration. that only time you can lose on this trade is really going to be on Friday. This is a 1-week trade. Look, I'm using the DS21s. You got to get out of this trade. You're out, okay, by the 20th. Come anything, you're out by the 20th. So you don't have to, worry about what we call this. This is what they call the Valley of Death. So on Friday, that's the Valley of Death, and you can only take that loss at expiration. And the loss, listen, it's not that much. How much can you lose? Well, okay, there is a 50-cent spread embedded in here, a 50-cent spread embedded in here, plus the 7 cents. Okay, at the absolute maximum sustained loss, it's $57, but you can only lose that if we fell at 25 on the button on expiration day. The stars align, and I just told you how to circumnavigate that. So if we explode to the upside, well, I got to tell you, if we explode to the upside, okay, this trade is mitigating a degree of my risk. So I put on a couple of contracts. I was just probing a little bit. Let me show a couple of my positions here. Okay, so I'm just probing a little bit in this particular case. When I say I'm probing, I was probing price. I've got a 10 by 30 on right now. I'm going to have to add to it, though. Hopefully we don't explode higher on Monday, but I'll add to this. Even if we drop a little lower, it doesn't matter to me. I need this position on for my other positions. You can see I've also got a duration position. I have a 28 put just on the XLF. All right, let's move onward and upward, of course, from the XLF. By the way, if you want to see my net XLF position, if we go higher in the XLF, I can make money. If we go much lower in the XLF, I can still make money. All right, let's kind of continue on. The other product I'd be a little nervous in is the IWM, because these are the products that have been beaten down, right? They're where you want to construct this trade. And please, this trade is not elaborate. This trade is not complicated. This trade isn't even pretentious at all, okay? This is going to be a 1 by 2. Now, the previous trade was a 1 by 3. This is a 1 by 2 for a 19-cent debit. Drop it over to the Analyze tab. Okay, I'm going to hide a couple of my positions in here and just zoom in. Okay, again, very, very similar. The good, the bad, the ugly. Well, in this particular trade, there's a $2 wide spread. What's the most you can lose in a $2 wide spread? You can lose $2. So I could lose $200 in this trade. I could lose $200 if I held it until Friday, and which I'm not going to do. Okay, listen, again, these trades are for the next 7 days if there's going to be an explosive rally. And to me, it's one of the most essential things, because I'm telling you, when you come down to a crossroads, I know that everybody tunes into this video and they're like, well, what's the next move in the market? Well, I got to be very frank with you, okay? These, okay, being the IWM and the XLF, have already broke the volatility box, okay? And their corresponding volatilities have actually gone up considerably. So if you take a look at like the IWM, it's jacked up now to about a 26.5% volatility. Go look at the XLF. The XLF is at 34% volatility. Compare that over to the spiders for a second. And of course, just using some ETF, the spiders are at a 23 vol. So again, the volatility is really starting to pick up in the products that have broke outside the bottom of that volatility box. But having done this and having broken lower, it doesn't necessarily constitute that the entire market is going to crack and go. What it does, though, put us in is this really, again, precarious position where these products, if we're going to rally, these are going to fly higher. And when they do fly higher, so be it. If I do the IWM spread, cruise over here. If I do the IWM spread, what do I have at risk? 19 cents? If the market cracks and breaks lower, I'll lose 19 cents. But I have bearish positions on. Okay, if the XLF breaks considerably lower, okay, what's my risk if the XLF breaks considerably lower? Well, negligible, right? If the XLF goes considerably lower, well, the financials go lower. I've got all these bearish positions. I'm going to make money. But if the marketplace turns around and the XLF rallies, I'll take a hit on my positions, but I'm going to actually cover some of that risk using, again, these ratio back spreads as a hedge. Very, very important that we kind of understand that. All right, other areas that we do want to cover here, albeit briefly. Let's cruise over to the SPX, okay? And in the SPX, we'll actually bring up our expected moves. As I was kind of denoting, kind of zoom in really, really tightly here, okay? We're coming off of a week. We're coming off of a week where we had this $82 expected move. And I was kind of mentioning this, and I can't really stress this enough. The S&Ps were tracking a little bit higher. We never got anywhere near the edges, though, this week of the expected move, which, by the way, that's the first time that's happened in a very long time. Almost every single week, we've actually cracked expected move, touched expected move, ripped expected move, destroyed expected move. Okay, this previous week, we had nothing. But I got to tell you, the entire week, I just kept feeling like on an intraday basis, I couldn't get my own footing. Like this past week, I had a couple of really profitable trades, okay? But the S&P futures just felt awkward, unstable, okay? And as I've kind of termed, sketchy. And it all came down basically Friday, where today, when the S&Ps broke a bit lower. Let me tell you, nobody saw a 50-point move coming. Nobody saw that coming. As I said, again, financials. The reason I want to bring up the financials, bring up their auto expected move for just a second. The financials have continuously ripped through the bottom of their expected move. That's why, again, there's efficient markets. This past week, the S&Ps were rather efficient. The inefficiencies are coming, big way in products like the financials. All right, last couple of things that I want to leave you with over here. We had a spectacular week of trading. So if I just back up like the last 7 days, okay, this is just this one account, about 37 fills. We had opened a position in McDonald's. We had closed a position profitably in McDonald's. Okay. Now I want you to check this out because it was kind of a cool week of trade over here. So if you take a look, and again, I break up my contract size and so forth. Here's a position that I closed. It was a bearish position inside of McDonald's that I closed for 341 credit. It was in out spread. Okay. The very next day, I turned around. It's the exact same trade. Okay. Just a different expiration. Here's the January 11th. Here's the December 14th. So I closed the trade, opened it again. Okay. With the exact same strikes, okay, for the most part, for a 206 debit. So I took a debit, and then if you look forward a little bit, right here, I closed it again. So I had reopened the trade and closed it again. There were a lot of trades that went that way this week. There were trades I did in GE. I was selling premium against some GE positions. Here's actually a Microsoft position. And again, I'm just scrolling down some of the trades that we did this week. That Microsoft position, we opened it for 91 cents. That didn't last very long because we whacked out of it for $1.23, literally like 2 days later. The in-out spread, the rule is if you can make more than 30%, okay, in the midst of 3 trading days, you close it, you take the profit, you absolutely run. Where else did this actually occur? None other than we took a position inside of Amazon. Amazon, we paid $1.15, $1.18, did quite a number of contracts in here. We knocked out of the entire position for $1.60 credit. Okay, so we paid about, let's call it $1.15, took out like $1.60 credit out of it. And it just goes on and on and on throughout the course of this week. We also had some nice intraday trades. Okay, so here's actually an intraday trade where you're seeing me turn around and buy the spiders. Okay, looks like I just traded in this particular circumstance. Even in a marketplace that's trading quote unquote, totally sketchy, went out and bought a spider put for 223, sold it for 272. We had another one we did on Bank of America today. And I got to tell you, on Bank of America, we just got out by the skin of our teeth, paid about 37 cents, got out for 41 cents, small profitability. You can see some of the trades I've done in the XLF. People, this is a trader's market. That's why I'm showing this to you. Okay. Pretty much anything we were throwing at markets, okay, this past week seemed to work. Why? Volatility is kicking up. And though those futures may be trading a little sketchy, that is what creates opportunity. With that, again, look at some of the hedges in the XLF. Look at some of the hedges in the IWM. I don't necessarily suspect that the marketplace is going to explode higher, but I know better. I've seen this movie before. We're ready to break lower. Absolutely ready to break lower on the S&Ps. But you have to cover your proverbial behind. And my risk is to the upside. Therefore, I got to be careful inside of the financials. I got to be careful inside of the IWM. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend.